Welcome back to the TD Ameritrade Network. Let's continue to look at apparently the new favorite of earnings, its financials. We got Tom Lyon in studio to trade with us, but first, David Ellison is a portfolio manager of the Hennessy Large and Small Cap Financial Funds. Welcome back, David. Good to see you. So, look.
Hello, Oliver. How are you?
Doing well. Looking at some banks that are getting to level Wall Street finally. Bank of America, the latest. So, what are we learning here?
Well, I think the banks are telling us, at least the bigger ones, that the economy is good, credit is decent. I think the push is coming, or at least the excitement is coming, because the Fed has now come in and started to be more, QE friendly, even though they won't say it. And I think that's going to hopefully steepen the curve. And that's really the only problem in the industry. If you look at the earnings that we've had so far, the only thing that's wrong is the margins are coming down. And if that reverses over the next, 6 to 9 months because the yield curve steepens, then earnings are going to continue to go up. So I think the story now is the Fed getting involved in the repo market, which has allowed them now to be more involved in hopefully controlling the short end of the curve.
I think this is a good point, David, because we saw from JP Morgan's loan numbers, there's still a pretty robust market for those loans. So if you make a little bit more on them with yield curve steepening, kind of the cherry on top. It looks like M&A is also playing a pretty big role in some of the big Wall Street firms. Any stocks that you're particularly keen on, that you're impressed by, that have reported?
Well, so far, I think clearly JP Morgan and Bank of America, to me, are the two that have really shown that they're growing loans, prudently. Again, you can always grow loans and make a lot of bad loans, and it shows up later. But I think they're cutting costs, they're rationalizing the low margin businesses, and they've been doing that for a while, and it's starting to show up. And I think they have the ability now to really show, many years of earnings growth. I mean, they're not going to grow, they're not going to double earnings or triple earnings. But I think they're showing you that in an environment where rates are low, the economy is, not as good maybe as it was 6 months ago, that they can still do pretty well. So, I think we're in a recession right now. This is the recession that we're having. And this is the new look of what the recessions are going to look like, because the Fed is too involved to allow a recession like we had in the past, especially driven by the banks. So, the banks are going to continue to lend. They're very cautious, and I think that's helping the economy, but it's also making it look like there isn't a recession when there is one. It's happening right now. So this is the recession.
So here's the question then, David, because the loan part of this that looks still solid this quarter, if we are in recession or on the precipice, or, basically, is that going to start to hit that activity, though? If we do start to see that slow down, I mean, how important is that going to be? Or is your point, look, maybe we've gone through the trough from some of these numbers?
Well, I think the credit cycle, because of the regulatory structure, and you've heard, from JP Morgan that a big part of the repo issue was that they weren't allowed to participate because the Fed won't let them. And so you're in a situation where the Fed is really controlling, a lot more than you think. I mean, the large banks effectively were nationalized in 2009, 10, and 11. And that continues and will continue for, I think, indefinitely. But I think the recession shows up in slower loan growth, not in credit issues. If you look at the banks, when there's ever a credit issue now, they just stop lending, write it off, and move on. And you saw that when oil was going to zero a couple of years ago. They just, stopped lending, and they moved on, wrote the stuff off, and moved on. And you'll see that in auto if it happens. You'll see that in credit cards. But so far, you're not seeing it because they're just not lending the way they used to. The FICO scores are high, the down payments are high, and I think people are generally more conservative about borrowing money than they were prior to 2008, and that's showing up in less loan growth. So I think the market now, we're in a recession now, and the Fed is cutting rates. They're providing liquidity, even though it doesn't look like we're in a recession. This is the new kind of recession driven by the fact that the large banks are nationalized. We don't have the volatility in the financial system that we used to have, and that's helping the overall market and the overall economy.
David, one of the other aspects of this quarter's earnings, when we look at the trading side for some of the big Wall Street firms, is really interesting. You've got the likes of JP Morgan with a big surprise on FICC trading, and Goldman Sachs, long kind of thought the stalwart of that realm, disappointed a little bit. Then I look at Bank of America, and they've got a pretty nice equity trading number this morning. So as an investor, what role is that playing in terms of picking favorites among Wall Street?
Well, I'm not a big fan of trying to capitalize that kind of earnings. Those earnings are very episodic, and they're great when you have them, and the brokers get paid and the investment bankers get paid. But what about next quarter? What about 2 quarters from now? The issue is that business will be there. It's going to be up and down, and it's under a lot of price pressure. And you've seen, obviously what's happened with a lot of the brokers, started with Schwab. And I think that's going to continue. So to me, it's really what they're doing on the expense side and on rationalizing some of these low margin businesses. I think part of the issue with the repo market is that people aren't making enough money in the repo market, and when it gets a little clunky, they just get away from it. And the Fed's had to come in and basically, in a sense, take over the repo market because the banks are saying, look, we can't make enough money to take the risk. And so we're just not going to do it. And I think you're seeing that in these other areas. But again, the market's been good. Capital markets are open. Bond markets are open. These banks are making their fees. But it's not something I'm going to pay a 20 multiple for.
Interesting.
And that's why the banks trade at 10, 12 times earnings, and something like Visa trades at 30 times earnings, because people view that part of the earnings as being, what are you going to pay, 5 times earnings for that? Because next quarter could be a lot worse. It could be a lot better. But
you've seen that volatility, yeah. I like that point. I mean, it's basically been a quarter-by-quarter situation. David Ellison, really nice setup for us. Pleasure as always. Mr. Ellison is a portfolio manager of the Hennessy Large and Small Cap Financial Funds. We'll be sure to follow up with David. But right now, Tom, let's talk some trading here. He actually is a nice setup because you've got Visa and JP Morgan. Let's talk the JP Morgan side first, as once again another PM that tells us they like JP.
Yeah, higher fees, better than expected earnings yesterday, this is one of the leaders. You got the Jamie Dimon
just broke out.
Also, up 23% year to date. So what I looked at, the earnings news is out. So that catalyst that could move the shares violently is already out there. So what I looked at, something neutral to basically slightly bullish a little bit. Stock's currently trading about $120 per share, just below the all-time highs that they hit in September. But what I looked at was doing an iron condor. This is set up as an iron butterfly, Oliver, because I've got 2 verticals in here, but I've got a common short strike where I sell the 120, 124 call vertical, and also selling the 120, 116 put vertical. I'm collecting a $2.70 credit on that. It's a $4 wide on each vertical on that. I went out to the November 1st cycle, so you got about 16 days only. So I want to do something short term to see JP Morgan stabilize after the event risk is gone. You're collecting $2.70. You've got a $1.30 in risk on each spread that you do. It's really a neutral spread, and you got your break evens there. 117.30 to the downside, 122.70, which is above that all-time high, to the upside. So you got a nice little range there for the stock to trade.
A little less bullish than when we looked at yesterday in JP Morgan.
Yep, and it takes advantage of time decay, or theta, that decreases or contracts the value of that spread, so you can buy it back cheaper every day up until expiration in 16 days. But then also, it's a short vega or short volatility trade. So if volatility remains low because that earnings event's already passed, that's also going to help contract the price of that so you can buy it back cheaper.
We also heard he mentioned Visa too, which I think is interesting, a higher valuation company, the growth that doesn't exist for some of these on the top line for the banks. How would you look at Visa right now?
Well, you look at the strength of consumer. We had a lower than expected retail sales number this morning.
A little spooky.
But you saw some revisions to previous months, which actually helped kind of cauterize that downturn that you were expecting on that retail sales number. What I looked at Visa was just taking advantage of it's pulled back from its all-time highs. They got earnings next week. So volatility's elevated in here. I went out to the November 22nd weekly series, and this is a neutral to bullish type strategy. So you've got about 37 days till expiration, but you're capturing that elevated volatility due to earnings next week. And I sold the 172.5, 167.5, $5 wide put vertical for a $1.10 credit roughly. Stock's down today, probably based on that retail sales data, but this gives you a nice cushion and a probability of over 60% that that short 172.5 strike is going to be out of the money at expiration. You collect 110, you've got $3.90 in risk, but you've got more risk in this trade because you've got that cushion to the downside before you start getting hurt. And if you want to own the shares, this is a great way to take advantage of buying it at a lower price point in case Visa does fall back below that 172.5 strike at expiration in 37 days. But I gave myself a little bit more time in something like this in case earnings comes out, we see some volatility, some movement in the stock. That gives you a little bit more time if you still have that conviction that Visa is going to rise.